Hi, and welcome back to DoubleLine's Channel 11. I'm your host today, Ken Shinoda. I've got my special guest, Jeffrey Sherman, Deputy CIO. Thanks for making it down to the office. And we're here for our second episode of What Now?
Very original.
Yeah,
right?
we thought, when there's a lot of volatility in the marketplace, maybe we see some big moves. Investors are wondering kind of what to do now. We had an episode about 2 months ago. We talked about how we like to set up for the year. But now we've had the Ukraine war. You had a lot of volatility in risk assets, commodities spikes. So here we are today. So last time we had What Now was in September of 2021. And what we thought then for fixed income was stay short duration, which has been the
right idea.
Right idea. We thought that inflation will persist for longer than the market expects. Treasury yields would continue to rise. Unfortunately, inflation seems to be more persistent than even we would have liked.
Yeah, I think we took a victory lap on that because we said that inflation would be high for the year. I think we gave each other a high five, and I'm like, wait, we shouldn't be celebrating this, right? And I still feel the same way today.
And in that environment, that low duration, higher yielding credit can do okay in that environment. Low duration has definitely been working. Some parts of the higher yielding credit market have been working. U.S. high yield has been hit, as we'll see in a moment, but bank loans and some of the securitized assets have done better than other risk assets like equities. For equities, our view was that, look, stuff had gone up a lot in price, especially the U.S., so we thought that the U.S. looked rich relative to other non-U.S. markets, and of course, that this value looked cheap relative to growth, and we'll look how that turned out in a second. And lastly, commodities we thought would give us potential upside, diversification benefits, and I think everyone wished they owned more.
I think what's funny about this when we look back at it, or not funny, it's like we got a lot of the themes very right, and we're still losing money because this is a market where a lot of things are down outside of the commodity position, right?
Yeah.
So many things are down in this market. So it's that whole, well, we did better than some other things out there, but it's still no fun right now. And I think we've all been pretty miserable this first quarter of the year, where there's very few places to hide.
Yeah, I mean it's we're ahead in some of our strategies relative to our indices, and we joke that being ahead never felt so bad. Right?
Yeah, right, exactly.
Ahead on the downside doesn't feel that good. Well, here we have what's happened, cross-asset performance. We'll just look at year to date, but since the real thing that worked on the equity side has been value relative to growth. From the last time we filmed this, when we talked about that, that's value is outperforming growth. If you look at the S&P value versus S&P growth, about 600 basis points. The non-U.S. stuff.
The only bad thing about that is it's primarily energy, right?
That's right.
And the energy's been the really key part of the market that's done well, as you see off the commodity prices, but it's very concentrated.
Focused.
That minute. Yeah, exactly.
The non-U.S. was outperforming for a while until obviously the Ukraine and Russia news hit, and that's changed our view on that front. Yeah. Fixed income returns, everything in the red. Treasuries down almost 5 year to date, even TIPS down 2, MBS down 4, IG corporates, the big loser, down 8.4, but it's up a little bit now, rally last couple of days. High yield down over 5, and bank loans were the big winner, floating rate only down 1%, but still down on the year.
Yeah, I didn't really go back and look at this, but I think this has actually been the worst quarter for fixed income in my career. Because I wasn't around the 94, but that didn't seem to be, the pain wasn't as bad because there's higher coupons, higher yields coming in here. And this has been a very, very brutal start. And if you rewind the clock a year ago, right, it was an ugly first quarter. By around St. Patrick's Day, that's where things started to kind of normalize at the end of the quarter. So, we're hoping there's going to be a little bit of relief there, but as we go through the data, maybe not so much.
Yeah, I agree. I was thinking, actually funny, I was thinking about that this morning too. I do think it's, at least as far as I can remember, it's the worst start. Maybe 09 was worse, but it was so long ago, and it felt like things happened a little bit slower.
Right. Well, and also I think the fixed income market was a little okay then too, right? The risk assets bottomed in the first week of March of 09, right? So It just, just seeing the pain here. I mean, even like during taper tantrum, which felt horrible, right? When we went through that back in 2013, it was just like every day the market's down, every day. And like you get a rally, you get a couple ticks rally and you sell off half a point the next day. It was brutal, but this one has been really, really tough.
Yeah, and so dollar strength into the rising rate environment, of course, commodities up largely across the board, and it's been the one place you can find some green on the screen.
Yeah, absolutely.
So what now? Here we are, March 2022, almost to the end of the quarter. So what's going on in the macro world? Obviously, we're heading into this global policy normalization mode, the U.S. being the most hawkish, given the inflationary environment. Here is a little bit worse than it is in Europe and Japan. Yeah. And so that Fed put that we saw in the 2018-19, and then obviously during the pandemic in 2020, it's likely much lower. Like the Fed's not going to step in because stocks are down 15%, right?
Yeah, and I mean the thesis is that inflation is paramount right now, and the Fed is fighting inflation. I'm sure we'll talk about the Fed and everything that's been going on there, but ultimately, I think there is a disregard for risk assets right now. That the Fed has been accused of exacerbating the wealth polarization in this country and supporting risk assets at the expense of kind of the populace, let's say. And so I think the key difference here is now the Fed, it's paramount. It is inflation, and it's markets be damned for the time being, that we really have to focus on inflation. And that's the rhetoric that has changed massively since Powell got renominated on November 29th.
Yeah, especially since unemployment has come down a lot now. So not only is he's not worried about the markets, they're obviously up a lot, but also that employment picture has gotten a lot better. So,
and one thing he said in there too is that we have wage growth, and wage growth is good. And that's one thing that he likes to see in there. So if there is some pressure on the labor market, that is something that helps broad participation. And so that's what the narrative that's changed with the Fed in the last couple of years is that they talk about broad participation. They look at different demographics. They don't just look at what the wealthy are doing. And so I think that's a difference in opinion than we've seen, let's say, in previous Fed chairs.
And that may be one of the reasons that they were slower to act as they saw wages increase, because they wanted to let the broader populace benefit.
Yeah. Well, the problem you have, though, is that you have this whole Phillips curve argument, right? Like higher inflation leads to higher wages and then potentially the wage price spiral. But the Phillips curve has been broken since it really was introduced back in the late 70s. And so, or maybe it was the early 80s. But the Phillips curve really hasn't worked. But that's really in the Fed's framework, right? To have, full employment and contain, they call it price stability. To juxtapose those two things, you have to have the Phillips curve argument. So it's kind of funny that you hear Powell saying, well, we're going to bring inflation up, but we're going to keep wages up, right? Because it is contradicting, kind of their belief in this Phillips curve.
Yeah. Well, unfortunately for the Fed and for Powell, this Russian-Ukraine conflict has put more near-term pressure on inflation and commodity prices, as we've seen, and it's definitely lowered the global growth outlook in the U.S. It's taken it down about 50 basis points on estimates for real GDP. So recession risks have definitely increased. The R word is definitely being used more. It's on everyone's mind. Much data that we look at doesn't seem like recession's imminent this year. Could be something of a risk down the line. We'll talk about that later. So fixed income, there's been this massive repricing and treasury yields higher. Credit spreads are, in some markets, the widest that we've seen since kind of since the summer of 2020 when markets reopened. So it seems like if you have been underweight fixed income, it's time to, we joke here, it's time to nibble or prepare to nibble.
Prepare to nibble, I think, was the mandate that we talked about this week, and that's a professional term, by the way, prepare to nibble.
Yeah.
But, the thing about the rates market is that this is not just a U.S. phenomenon. This is a global phenomenon at this point. Inflation is everywhere. Right, inflation's not just in the U.S. This is not just a money printing exercise in the U.S. And so I think what you find here is that this is coordination. And so whereas, let's say in 2021, whenever the U.S. rates would go up, you had this natural buyer from overseas, right? Because they could come into our market, get a higher yield, hedge it back in the currency, and still have a higher yield than investing locally. Because this rate move has been commensurate across the globe, you don't have that incremental buyer, and I think that's really the game changer that we've seen year to date.
And we'll see. And one of the things that caused the market to rally in 2021 was also Japanese year end happens in March, and they typically come in and buy afterwards. So I guess we'll know in the next couple weeks if that's going to be a force that could help keep yields lower here.
But even Japanese yields have gone up. And now it looks microscopic when you look at everybody else, but JGBs, what are 10s on JGBs, around 20 basis points or so today? I mean, it doesn't sound like a lot, but they've moved from being kind of in that negative range.
That's right. And Germany as well. Also in fixed income, some of these alternative fixed income assets that they've done okay over the last couple of years, but equities have been on this huge tear, generating 20, 30% returns, where, with bonds, even on a levered basis, to get 10 is good. But that type of alternative fixed income, that private credit, private debt, may actually outperform equities in this environment.
Yeah.
Going back to equities, we still think value looks like an important allocation in a portfolio. Obviously, certain parts have run up a lot, like energy. But our conviction on Europe and EM, it's a little bit more challenging with what's going on out there, with the dollar strength, with the war. That may struggle for a little bit.
Yeah, and I've kind of revised my thinking about Europe for the time being, because I think the stagflation risk that people talk about, and they throw that word around a lot. I don't think it means what they think it means. But I think the stagflation risk is real in Europe, because they don't have the bastion of growth that the U.S. has had. And you've seen, since the history of the euro, this is the highest level of inflation they've ever seen, right on the HICP. So it's running in the mid-5s right now. So looking at that, I think the stagflation risk increased significantly. And as much as we're talking about commodities, the localized commodities, so like natural gas inside of the Eurozone trades at like 10 times the price here in the US. So where our prices went up like 60, 70%, in those regions they went up like 400, 500%. So this is a lingering effect, and we talk about, okay, well, it's inflationary. Well, it's inflation, but that ultimately does stymie growth. It is disinflationary over the long term, because if you only have so much money around and the necessities cost more, right, and commodities are a necessity, it is problematic. So we're dialed that back a little bit. Also on the EM front, we're watching the dollar here. I think, you don't want to be short the dollar right now. I know we've seen, kind of some moves slightly down off very elevated levels in the dollar, but I don't feel that trend is underway at this point in time. So I think you want to be sitting closer to home right now. You want to be ready, get prepared to nibble, you know, as you said. But we want to dial some of that back a little bit at this point.
Yeah, the one place that has done the best has been the UK. That index, though, is very value-oriented, and it has a lot of defensive-type sectors like healthcare.
And so is the Eurozone, by the way, too.
Yeah, and it has also a lot of commodity-related names in there as well.
Well, and it's funny you said that the most hawkish is the Fed. And yes, if you look at the path it is, but the BOE, the Bank of England, is actually ahead of the Fed at this point. They hiked for the third time now. They're up to 75 basis points. Woo, high rates there. But the path that they're expected to take is nowhere near the path that the Fed laid out for us this week.
That's right. Commodities had a huge run. It's hard to get really bulled up here after this kind of blow off here. So from a trading location, it doesn't look that great, but in the long run, if we see a pullback here, and maybe if things calm down in Eastern Europe, you'll see that pullback. It could be a good chance to kind of
we advise clients to take chips off the table. I mean, like at one point, our commodity fund was up over 40% on a year-to-date basis, and we had some clients that are separate account. They came to us and I'm like, yeah, you should take some off here, because this has been a blow-off run-up here. Look, I think there's still going to be pressures. The supply chains are not going to solve themselves overnight. And I think that you're not going to have a lot of demand destruction there. So definitely the playing field for commodities has changed due to this invasion of Ukraine.
Yeah, and kudos. Last time in September, I think we were about $75 on crude oil, and you thought we'd get to 100, and we got to 120.
Yeah, well, I mean, for the wrong reason, right?
Yeah.
It's not because of invasion. None of us want that. But I think structurally we can stay around these levels. I think 90 to 100 makes a lot of sense right now. And unfortunately, that means there's more pain to come as people, start to think about their spring breaks. They think about their summer planning, and that's the big driving season. And we're seeing it already with the airlines as well. That fuel costs are getting passed on. Airline ticket prices have been going up meaningfully as well.
That's right. All right, so in investing, we always have to look at the macro environment. Here we go. We'll see kind of what we think about. We'll start globally here. World GDP forecasts. They've obviously been coming down, but still positive for at least 2022. right?
Well, and you look at it, it's above the range, right? If you look at those range where we've ended each calendar year since 14, still, even with this downward revision, and this already has now the Ukraine crisis inside of there, it has high commodity prices in this forecast as well. And so we're still looking to be kind of slightly above that trend area. So, that's why the R word, as you called it, it
Don't
just
say
seems,
it.
I can't even say it. It's a bad word around here. But ultimately, I think it's very challenging to see a recession this year, especially a global recession, just due to the fact that there's still a lot of pent up demand inside of the system.
Yeah, we've got kind of the reopening that's probably emerging globally outside of China, and we'll look at some slides that show that. Here's economic data change globally. You got US, Europe, emerging markets, China. It's all coming down, but it's still kind of at its average.
Right. So the way that this chart is interpreted, when you look at the economic data change, is it compares an amalgamation of economic statistics today to what they have been over the past year. So it just says, are you above or below that average experience of the last year? So yes, it's come down. That's where the fear is coming of the growth slowdown. But you look at your charts, and all of a sudden, they're just all kind of on average. So it doesn't feel as bad. The data doesn't look as bad as some of the sentiment is out there.
Yes.
And especially when we come back home, which I'm sure you have more slides on that.
Here's economic surprise. This is again US, Europe, and China, and you can see that this is moving up. So there's more positive surprise coming out of some of the economic
Right, because there was so
data,
much
too.
negativity out there, right? You see the trends going down, but the data is actually delivering above expectations. We know that's how markets price, right?
We just got yesterday, we had some manufacturing data that came in stronger than expected.
When you got the weak one early in the week, the Empire. So pick your poison. And this is why I think you have so much choppiness in markets right now, is that half the data you can pick too that looks kind of weak, and you can look at some very strong data as well. So I think that's what we keep having these debates internally about it, is which one should we be focusing on? And I think, as we talk about positioning, that's where you got to play for both outcomes.
That's right, yeah. This is nominal GDP growth by year through the past, and the yellow lines are estimates, and you can see just like global growth, it's above that post-global financial crisis kind of market we lived in, that kind of new normal of lower growth, lower inflation.
Yeah. So I think when I look at this chart, what I see is that, okay, wow. I mean, these numbers that we're looking at for 2022, even though we're talking about it being slower, a little bit more inflationary, nominal GDP is back to the level of the 80s, right? That's what you see in this chart. It's above what we've seen in the 90s. But also, it's not the best kind, because you think about this, it's probably a dose of more inflation than growth.
Yep.
But at the end of the day, given the debt burden we have as a society, nominal GDP growth is what gets you out of it. So a little dose of inflation. The Fed wanted a little bit of inflation. Be careful what you wish for with their average inflation targeting mandate. But you're starting to see that it's kind of getting to that kind of 7% growth rate.
Yep. We'll look at some positive stuff here. This is leading economic indicators. Usually this gets close to zero or below going into a recession. So this says you're far away right now, and there's a lot of inputs that go into this, like stock prices and a bunch of economic inputs. ISM manufacturing, this is US, both services and manufacturing, still north of 50, still very positive.
Yep.
Yes, it's coming down.
It's coming down, but look at where it was. It was all-time levels that you saw in it too. So this whole deceleration is putting us back more into kind of normal, or what were more normal ranges. And so when I look at manufacturing services here, I know we stripped out the global side as well, but the numbers are pretty powerful right now. And so this just talks about there is underlying strength in the global economy right now. It's just not as strong as it was 12 months ago.
So one of the things that we can look forward to, we had I would say the Omicron-related slowdown. If you look at Q1 GDP, Atlanta GDP now, it came down a lot. I think part of that was obviously the lockdowns, which have been slowly being removed. Finally in Los Angeles, as we sit here without masks in our office.
We can actually go on the trading desk and not wear masks.
That's right. You can walk into a store and not wear a mask. It's kind of refreshing. So this is just one of the things that's definitely picking up. One of our colleagues was at the airport today, said he hadn't seen it this busy in forever. This is TSA traveler throughput, and the green line is 2019 pre-COVID. The red line is 2021, which is better than 2020, which we don't have on here. And you can see that this trend line is almost back to 2019. So this is very positive for kind of global travel.
Yeah, and I'm going to tell that colleague of ours that they haven't been traveling much either, because I've traveled throughout the pandemic, and there were some really big peaks last summer, too. But look, I'm going on a business trip next week. I mean, it seems that we're trying to get back to the swing of things. So.
I'm going on my first trip in 2 years in early April. So, and the hotel I used to stay at in New York is closed, which is kind of sad, but I guess life will move on. And on talking about hotels, hotel occupancy. The blue line being historical, the black line being, of course, the pandemic, 2020, the dotted blue being last year and this year. We're almost back to trend, so kind of the same theme.
Yeah, and there's seasonality now you can see, for the time of year, just because, there's more, people taking vacations and things in there, but it's business travel. That's what's really going to drive. That's what we talked about, for the last 2 years, is that business travel has to come back to get the TSA throughput up, as well as the hotel occupancy. You can't just rely on the consumer to do that.
And this theme we're talking about right now, it's about what the consumer is doing. The consumer is traveling, the consumer is going to hotels, the consumer is going to start spending money on consumer services. And so here we have goods inflation versus services inflation. Everyone go buy stuff because you're stuck at home. Obviously shocked that demand for goods, the stimulus from the government doesn't increase supply, just increase demand, and voila, you've got goods inflation. We were expecting that to come down. It has not.
Yeah, I missed that one too, because if you'd asked me like last summer, I'd say, okay, once we start reopening, people are going to stop spending money on things and go back to the experiences. And so the service side, you've seen some of those experiences come back, but don't forget a big piece of services is housing. Right, and so we all know the issue. We've harped on this for so long about the difference, the discrepancy between what you get on owner's equivalent rent and just rent in general inside of the service component versus what we see, in the housing market or the rental market. And so, unfortunately, that's going to continue to put pressure on that data set. And so, I would have expected, and I got this wrong, that there would have been this handoff. But the problem you have still is, remember, this is all done in nominal dollars. The inflation is showing up there on that chart. Yep. That's the good side of the equation. So if you want to be critical of like retail sales, it was a strong data print, a good revision. Last month that helped, the forecast for GDP for the first quarter. But it's measured in nominal dollars. Mm-hmm. So yes, things cost more. It looks like the consumer is more robust than probably they are. Because one of those goods you consume are commodities right now. Yeah. I mean, gasoline.
Over $6 in California. Yeah. Hit $7 in some parts. Yeah. So this is why the Fed is in a bind. They were hoping the red line would come down.
And Jerome Powell talked about this at the press conference, that he expected supply chains to resolve themselves. This is what the Fed missed. And look, a lot of us did, looking at it, because we got lulled into this world of disinflation or deflationary pressure in goods. We used to call it the Amazon effect, right? Things just get cheaper over time and they're delivered quicker and better to you. But this has been the conundrum, and this is why I think the Fed has really changed their rhetoric as well, is that they need to get that red line down.
Yep. And we follow some shipping container information. Yep. It does seem like the congestion, at least in the local ports here in LA and Long Beach, are getting better. I got a live view. Yeah. At one point I was like counting with my son, and I'm like, count all the big boats out there. And there was 25 of these huge shipping boats out there. There's definitely less now. So
I think it was average 13 days to unload. I think we're down to 2 now, right? So
they were just sitting off the coast. Yeah. They had nowhere to go. Yeah. There's companies that were making money with little boats taking food out to the guys on the boats. So the market has obviously increased its expectations of inflation. This is, as bond investors, this is what we look at. This is called U.S. break-evens, and this is based on looking at the Treasury inflation-protected market, the TIPS market, and the market basically thinks that short-term inflation is obviously going to be high, but it's not as high as what we're seeing on that last chart, right?
No, absolutely. I mean, look, the 5-year break-even right now is 360. I mean, that's a level we haven't seen since before the GFC. So I know your chart goes back about 5 years. So that is a huge change in the dynamics, because people used to believe the Fed. They're going to target 2. Look at that chart, how stable it is between 1.5% and 2% across the entire curve. all of a sudden now it's like, wait a second, we're going to have very short-term inflation. We know that over the next year. And then you get to the 5-year point and you're like, okay, well, you have to kind of compound that out. And so the market's saying, wait a second, maybe this isn't so transitory after all. But notice here that we never got anywhere near the levels we had last year when people were listening to the Fed and listening to the transitory narrative.
Yeah.
And we didn't buy into that story. But we also didn't think we were going to get to the levels of inflation that we saw in 2021.
Well, the market also seems to think that we're going to come down pretty significantly off the high headline numbers that we're
but
seeing
notice
today.
that little spike in that black line, though, too. That's a huge jump for 30-year break-evens. That is a big difference. So I'm starting to believe that potentially the Fed will also change their inflation target, where they're going to say, 2%, that's old stuff. Because it's higher, maybe we go back to 3. So remember, 2 is just a number, right? There's nothing special about it that says that's optimal. It's just that over the long term, over like hundreds of years, inflation's averaged about 2%. So that's where you start as your basis for thinking about it. So I agree that if you kind of back into these curves, what it says is, okay, you're going to get 360 for 5 years. Well, in order to get 294 for 10 years, well, that means you got to get about 250 for the next 5 years inside of there. So all in all, I just think it's the market saying maybe this inflation thing stays around a bit longer than we thought.
Yeah. One of the big hot topics, of course, which why inflation is where it is obviously energy prices, big input into so many things that we use. And gasoline, which hurts a lot of people on the West Coast, especially big commuting community out here in Los Angeles, built on commuting.
Yep.
They actually tore the trains down.
Right. Well, remember that, and also the taxi lobby didn't want the trains to go to the airport, right? So that's why the metro line didn't actually go there. That's going to change for the Olympics that they're building for. But what I find really strange that people say, the U.S. we need to crank up production. And so it's like, okay, but if this is a short-lived conflict, and again, it's horrible in terms of the human sacrifice and what's going on there. But let's say it lasts a couple months and prices are elevated, they're going to retreat down. So if you actually look at the curve, so commodities have a curve that you can trade out for futures. And so what you actually see is relative to about, let's say 6 weeks ago, so that's a couple weeks before the invasion, what you see is that the curve it's obviously steeper on the front end, but the back end of the curve, like 5 years out, prices are lower. Because the market is saying, well, we're going to react with some supply if it stays there for a period of time. So I think, even though this is short-term pain, I saw an interview with, I think it was the CEO of Chevron, and he said, look, when we plan, it takes 8 to 12 months to get the plan in place, right? You can't just go stick a straw in the ground. This isn't Saudi Arabia. Stick a straw in the ground and oil comes out, right? That's the old joke. But it takes time, and the wellheads take a long time. And like, if you ratchet them up, you degrade the well as well. So there's a lot of challenges with it. And so I know that, it's politically popular to say, yes, let's draw out the strategic reserves or we're going to crank out more oil. But I actually think that, again, the cure for high prices is high prices. And I actually think that this maybe does push the U.S. to more of the green energy revolution, like we've seen in Europe and the other areas. Now, the skeptic's going to say, well, look at what happened with this price spike. But there was a meme going around. I think I shared it with you too. It says, "How much has solar prices went, or how much has the wind price went up, since the invasion, right?"
Yeah.
And so I think it's going to get people to think a little bit differently. But we always need a catalyst. You called COVID the great accelerator. Maybe this is one of those ideas of maybe this is where we really push the green initiative here in the U.S.
Yeah, and I talked about it 2 episodes ago. The longer term kind of reflationary themes out there. One of them is obviously deglobalization, people bringing supply chains back home. That clearly seems like that's going to happen, right? The other one is more defense spending. It's happening in Germany.
Which is crazy, right? Like post World War II, you've never hear. I mean, the German, populace it's always been that we don't want to talk about war. That's kind of a bad spot in their history, and all of a sudden it's like, wait a second. So I do think that is a different trend that we're seeing out there. And, there is this self-reliance, right? And I think that's part of what you're seeing here. I mean, usually it would be just they call the U.S. and the U.S. gets involved, and you're starting to see a different dynamic here.
And the third thing, which we just talked about, so we have deglobalization, defense spending, which is part of deglobalization, and then a big movement you'll see over the next 10, 20 years is this decarbonization, and it costs money to do it.
That's right.
And there's a lot of spending that has to happen, and that can stimulate growth, a lot of job creation, and so on and so forth. It's not going to help us for like the next recession if it's here next year, but over the next 5 to 10 years, these are big secular changes that we spent over a decade experiencing the deflationary effects of deglobalization, demilitarization, right? And I think these are things that, you know, maybe it's not fully priced in, and kind of we can start seeing some of those positive effects down the line.
Well, that was our positive bias on commodities, was the decarbonization was going to lead to higher demand for commodities, especially like the things like nickel, palladium, things that are input, copper as well. And so ultimately, I think that, you know, this just tries to accelerate some of that. And, you know, when I think about like the Build Back Better, or, you know, whatever the heck they were going to call it, this is a perfect opportunity to do something like that. There should be a good multiple on these projects, right? You should get some decent velocity. They should be high-paying jobs. Yeah. And so, again, I don't look for the government to solve the problems, but I think incentivizing and getting the right structures in place, you shouldn't incentivize the oil producers to be more green. You should incentivize the industry as a whole.
Yep. So energy prices, when they spike, if they spike 50%, usually that recession has followed. We obviously have spiked a lot, but we came back down too.
So then we went back up the other day. Yeah, it's a little noisy right now, right? But I mean, like oil prices, you know, we're at negative 40. You know, if you remember that weird period back in May of 2020, and we kind of were like normalizing around 50 or so. So this move is more than 100% move over the last 18 months or so. And, you know, that is problematic. And like you said, you see it at the pump, right? And that's what people really realize. And that's really, I think, where the inflation narrative is going to resonate with the general population, right? Because they see it now, right? And they don't see it as a war premium or something else. It's just like, what's happened? Yeah. Right.
And not surprising, because of gasoline and higher food prices and war and inflation in the news, consumer sentiment is the lowest it's been since, you know, in 2009, and then it looks like 2011 during the European crisis.
That was also the fear of the double dip recession at that point too, right? And so, you know, you put all that on there, and then you look at asset prices. So you're miserable when you look at your statement or you open your portfolio. And so there's a lot of reasons that this sentiment. I used to always say consumer sentiment. It looked like the S&P 500 on a lag. But definitely that dynamic has changed in the last 6 or 7 years. I think it's just, you know, people are more curmudgeon-y, it feels like, right?
For sure. So this is one of the negative things out there. Definitely need to watch. I mean, we look at a lot of different data points and sentiment and asset prices. And, you know, there was a point, let's call it 6 to 12 months ago, where everything was kind of green and it was like an all clear, and we weren't worried. Everything was doing well. And now clearly it's more of a mixed bag. So we're on our watch, let's call it, right?
Well, I said we went from everything is awesome, you know, like that Lego movie, they had that song, you know, the everything is awesome. Yeah. That was the world we were in. And so I was talking to someone the other day, and they're like, well, how would you describe the market? And I'm like, everything sucks. Because the things that are doing well are the things that we know are going to cause problems in the long term, like commodities, right? So, but I said the good news is I think a lot of that is priced in now. And I think a lot of these painful moves are behind us. So prepare to nibble. I'm going to use that phrase all day.
So the Fed is starting their hiking cycle. The Fed, the market thinks the Fed's going to hike up to about 2.5%, which is right around where we got in 2018. We got a little video of the Fed. So let me get this video set up here. Well, that's Powell hiking, 25, maybe 50.
Well, you know, it's funny that we came up with that, and I don't know, it just reminded me, you know, it's cliffhanger, it's hiking in there. But the thing about that game is that it goes up until it breaks, right? And that's the track record that the Fed has, is that they hike, and it's too late by the time they realize it. And so the unfortunate thing is I think that metaphor or that parallel there that we see for that cliffhanger game, I think that's the fear we all have.
That's right. That's definitely the fear of the market. That's one of the reasons you've seen kind of the long end do okay recently. I think I know we've sold off big, but one of the things that's flattening the curve is that expectations of the Fed crimping growth.
Yeah, I mean, it's funny, as we were going to the Fed meeting this week, surveying people and asking opinions, the common response was policy error. But then if you asked, what is the policy error? Somewhere they're too far behind the curve.
That's
they
right.
need to go fast on inflation. And then the other folks were saying, oh, wait, there's too much inflation. They're going to hike. They're going to hike, and it's going to crimp the market. So I think you had this push and pull going on within that. But I think that the phrase on everyone's lips is policy error.
And it's pretty. Look at the volatility. A lot of this is the Russian invasion, of the volatility and expectations of hikes. We were all the way up at 6 to 7 hikes, cratered to less than 4, and right back up towards 7.
Well, I mean, then the Fed came out this week, and if you take their median dot plot, they have 7 in play. So, our boss Jeffrey Gundlach always likes to say, get rid of the Fed and replace them with the 2-year. But I think what you see is that the market has emboldened the Fed to move those dots up as well, because they're saying, like, it's priced in.
Yeah.
So if the Fed's like, we're going to hike 3 or 4 times, I think they lose credibility. The market's telling you it's okay. The market has it priced in, so they stepped in. What was puzzling to me, though, was not the 2022, because I started the year thinking maybe it's 4 hikes. And then, I was like, once we got the next inflation print, I'm like, then we're going to 6. So I'll buy into the 7. I'll take the 25 a meeting. Let me get back to that thought in a second. But what's happened in that dot plot was the 2023. And so on here, you show that there's roughly, like 2.5 or 2 3/4, let's call it 3 hikes for next year.
Yep.
But if you look at the rate that the Fed put on everything, all of a sudden there's 4 hikes next year as well. So now you have a cumulative 12 hikes, because there's 7, we already had one. There's 7 plus the 4, it's 11, because that's included inside there. But that was a big shift in the thinking across all the Fed governors. And now there's volatility around, the median's the median. But I'm starting to think that the Fed is going to try to do 50 next time. And that's not priced in yet, there's like a 40 or 50% chance. But I think what you're going to see is the next tour of governors going around, and it's already started today. Bullard already said, I'm the guy with the 3 handle. I want rates at 3% this year. But what's going to happen is I think the governors are going to go around and start to prep the market for a 50 basis point hike. So I think you're going to see a 50 hike. Again, assuming it goes well, the markets don't puke over this. We'll know in 5.5 weeks, right, where they are. But I think that they're going to set up for 50, and the balance sheet unwind's coming. Right? So they're going to double dose this. And so that whole 7 concept, it may not be 7 hikes, but it may be cumulative 175 basis points. And so I could definitely see that, especially if the next couple of inflation prints run hot.
Which they probably will.
Yeah, and forget the year over year. It's the month over month you have to watch, because they can use that as the reason to dial it back or dial it up. Forget the base effects and just look contemporaneously. So I know I'm long-winded on this, but I think it's very important too, because until we get clarity on what that balance sheet looks like, there's going to be choppiness in the market, because we need to know exactly all this supply of bonds that's going to come to the market.
Yeah, many were hoping that they would talk about it, and they just totally avoided the.
But I think as I think about it, I was in the camp like, give me a plan. Come on. I'm yelling at the TV. This is the one thing about working remote that day. I'm yelling at the TV and not on the trading desk. But I think what's Powell played it perfectly as I now look back, because what he did, he told you, we have a plan. It's not finalized. And then we're like, well, why wouldn't you give it to us? Because I think that they're gonna float these ideas out. You're gonna see Bullard, you're gonna see Waller come out. They're gonna be aggressive. They're gonna be super hawkish, and let's see how the market responds. And so I think he gave himself perfect optionality on that. And then in real time, I'm like, why won't he just tell us if you've already came up with it? But I think it's because they're gonna float some trial balloons, and they're gonna try to hone in and figure out what that exact dollar amount should be on the caps or whatever they're going to let.
And also, in the passage of time, you get more data, and they can, hope and pray that maybe inflation comes down, which it won't.
And look, every like 50 billion of runoff is something like, I don't know, it's like 4 basis points of a hike. So, look, that's another way of hiking this year too. I don't know if you can get 7 this year and you can take $500 billion off the balance sheet. but it kind of looks like that's what they're going to try. And I say they're going to try because the problem is they're not very quick to respond, and the markets, can convulse on this stuff. So watch the Fed governors. I always say, don't watch the Fed governors. Only person that matters is the chairperson. Focus on Powell. I think over the next couple of weeks, you want to focus on the Fed governors to see what tidbits they give us to tip their hand.
And so we've seen a repricing because of what we just talked about. The Fed has helped the bond market finally reprice, and on the long bond, my targets at the beginning of the year were kind of like 2 on twos. We got there.
Yep.
2.25. I didn't think we'd get there like in 3 months. I thought we'd get there at the end of the year.
Things happen faster than you think, right? It's like nothing happens, then it happens, right?
And 2.5 on the long bond. So we kind of got there, and that 2.5-ish, a little bit higher from there is the long-term trend line. And maybe we'll see some support on the long end. It seems like
the only problem with your 2.5, if you look and you go back 4 years, it's the pivot too, right? So the pivot point being the new high was the old low.
Yeah.
So that's the only thing that concerns me about it. But I'm with you too. We haven't broke through 250. Remember we couldn't break 2 on the long bond either. It was like every time we got there. And so I think we're at a critical juncture here. I'm not a buyer of the long bond. If so, it's for a hedging reason or trying to offset some risk somewhere. But I'd rather just sit on the sidelines and watch this a little bit because I think that pivot is very important as well.
Yeah, I mean, if we break through 225, 250, it seems like we're going to head higher on the long end of the curve, which is positive for financials. It's positive for...
Well, and that's kind of the contention about some of the balance sheet is that, okay, so the curve is a little inverted, like people are like,
sell some long bonds.
Yeah, right. And so you can dump things into the market, right? So I get concerned about that because that becomes too manipulative, right? The Fed's already manipulative to begin with.
Yeah.
But then they're actually trying to target all of these rates along the curve. And so that's the thing I get concerned about there. But don't rule out that the curve could steepen simply because the Fed makes it steepen.
And so here's the whole curve. This is 2s, 5s, 10s, 30s. Obviously, this big repricing, especially the front end of the curve. Relentless sell-off very recently. 2-year swaps like a week ago were like 30 basis points plus lower. So a lot of stuff is looking really cheap on at the front end. Jeffrey was on CNBC the other day saying, thinking about instead of cash, 2-year treasuries don't look so bad. Heard a stock guy, an equity guy on CNBC as I was driving in saying, looking at buying some 2-year notes in his PA. And if you actually buy some credit products where you can pick up some spread, you can create a very low duration portfolio that yields almost 4 today.
Well, and look at the 2-year, it's better than money market, right? Because even though the Fed hike
takes time.
Yeah, it takes time to get there, right? So if you have a 2-year horizon, there's nothing wrong with owning a 2% 2-year right now. So for people that are craving that yield, remember, we didn't have a 2% 10-year until this year, right? So you now have a lot less risk to do that. And as you were saying, and I cut you off, building that short duration portfolio, not taking a lot of credit risk, you can put something together that yields 4 today. So all of a sudden, the fixed income market is starting to look attractive. It feels horrible, but we were modeling some stuff. We got some products coming out, so we were modeling stuff. I'm like, man, this market looks so much better than what we were 3 months ago. Yeah, prices are down a lot. Yeah. That's what happens. But on a perspective basis, it's really starting to look interesting. And I think you can start to put together these more 60-40 portfolios. Now the bond market at these levels gives you the ability to do some stuff to offset some of the risk.
Yeah, I mean, if you believe the break-even curve, then you're actually generating some positive real yields in some of these lower duration portfolios. But the beginning of the year, the 2 things that worried me about the markets was that as rates rose, real yields would rise. That was going to put pressure on kind of equity multiples. That would put pressure on credit spreads, which it did. But we've seen this big move. So the big unknown to me and kind of the lingering threat as a fixed income manager is that balance sheet. And it is really big. I mean, this chart shows you I didn't pick these colors, but the peach is periods of QE. The blue is quantitative operation twist. And you can see the latest round of QE was like almost double all the other ones combined, right? So there's a ton of bonds that need to be unwound. Some of it can mature naturally.
Yeah, my fear, I shared this. I know we've talked about this many times back and forth, but my fear is also this concept that, well, because the balance sheet's bigger, they can unwind more. That's not how it works. That's not how markets work. It's marginal everything's marginal, right? So this is marginal supply out there. So I'm concerned because when Powell said, well, when you see the balance sheet unwind, it's going to look very familiar and it's going to be faster. He's telling you it's going to be bigger, it's going to happen sooner, but they're essentially going to let it roll off and probably not sell. That's what I glean from that. But I'm nervous about that because if you remember, by the time we got to unwinding $50 billion a month, that's when the market broke back in the fourth quarter of 2018. And I think they're going to start close to that, right? And it's I was chatting with my team today. And I said, how about this? Instead of doing 10, 20, 30, 40, 50 that they did last time, they do 20, 40, 60, 80, 100. And I'm like, that probably is their baseline thinking, but can we take that?
Yeah.
Right? And so time will tell. And are they going to do it monthly now versus quarterly? Because it was quarterly when they ratcheted it up. So I think they're going to be aggressive, and they're going to go, yay, we beat inflation, but they may cause the recession to come.
Yep. So it is a risk, something to be thinking about, something we're watching, and I think they'll talk about it by the summer.
Yeah.
Right?
What I realized in this, and then this is completely random, but the next Fed meeting is May 4th, right? So it's like the day before Cinco de Mayo. And I just realized that St. Patrick's Day and Cinco de Mayo are exactly 6 weeks apart because the Fed meeting was the day before and they're 6 weeks apart. So I don't know why that's relevant, but now you know kind of some of the inner workings of Sherman's thinking.
You have something to toast to, I guess, right?
Well, because what I said is like, look, at least like we can commiserate the next day and go out and celebrate with these kind of holidays we have where we go out and probably drink a little too much. So I'll blame the Fed if anybody's hungover after those. So.
All right, now we'll move on to fixed income, and this is global government bond returns, and the gray bars are a 1-year return, which look worse. But as bad as it feels in the U.S., where's the U.S. here? The U.S. is kind of near the top. It's actually better in the U.S. than a lot of the world.
Than most of it. I mean, if you split that, it's top quartile, right, in performance, but. I mean, this looks like a stock chart, right? When you say, oh, what's the 1-year return? This isn't what people think of when they think about bonds, right? And so no wonder there's been this, revolt about the bond market, and people saying, why should I own any of this? Because, I mean, look at these drawdowns too. I mean, they've just been massive. And so this is not what you said. But if you remember, what were we talking about 4 or 5 years ago? At some point, this has to unwind.
Yeah.
You can't have negative yields forever. It's bad for the system. And so this is called duration. And when you have no yield, we used to talk about this when we first started DoubleLine, right? If the thing yields 10 or it yields 11, who cares, right? It's good return, right? Yeah, we do care. But at the end of the day, if you miss the price by half a point or a quarter point, who cares? The yield offsets it. But now you have just the opposite. We care massively about the price because there was no income to offset it.
And that's why you see such larger negative returns in the European government bonds that in many instances had negative yields.
Yeah.
Negative yields, negative price.
I mean, that's the one thing compliance has never let us guarantee anything. And I said, there's one thing that compliance will probably let me do, and now they're going to cut it now that I've said this. But the thing is that if you buy a negative yielding bond and you hold it to maturity, I guarantee you will lose money. That's the one guarantee you can get because mathematically you will lose money, right? But you have to hold it to maturity.
And so here's fixed income universe, and maybe beginning of the year it was really just the duration that was hurting. The credit hadn't gotten hit yet, but I mean everything's just gotten hit.
Well, that's the reprice, right? Spreads have to reprice when rates move. And see, this is the danger that we talked about probably 6 or 7 years ago. Is that when rates go up, spreads can widen. There's this just old adage out there that like. Rates go up, spreads have to tighten because there was that relationship. But at some point, it's the yield that matters. And so if your base rate is going up and you had very little incremental premium on it, it needs to reprice because you can go to the flight to quality asset. And so that's where it's always a challenge about markets is it the old way of thinking? Do we have to be a new way of thinking? And again, you just have to, you got to have these conversations. You got to think through it, right? And we were talking about some of looking at some of these bonds recently, and you pointed out that like I think at this level now, if rates go up, backs up another 50, 75, I think spreads tighten. That's what you told me. Yeah. And I said that argument makes a lot of sense, especially in the mortgage.
Well, you got the double whammy. I mean, the spreads have repriced. We're in a lot of securitized. The the widest they've been since the summer of 2020 when the new issue market opened up. And a lot of that's just because money managers don't have money.
Right.
I mean, bond funds have seen outflows. I mean, we have money. We're just not sitting on cash.
Yeah.
And we're waiting.
And we're being patient too,
Yeah.
right? And like, owning cash has been one of the best performing assets outside of commodities, right? Because everything's down. But that's why we're saying prepare to nibble. We've been nibbling this week a little bit on some of that stuff, and I think that analysis is right at this level. And by the way, you're not moving the whole boat. You're nibbling. You're starting to step into it, and we've been doing this all year.
And one of the things that has been really shocking has been the rate volatility. The blue line is the MOVE index, which tracks interest rates. You also have the VIX on here, which is the stock volatility, and that's in the black. But rate volatility has actually been higher.
Yeah. I mean, they're different scales, and they measure a little bit differently. But yes, I mean, so when I look at this chart, I say, okay, we've had a lot of rate vol. And if you look at that and you look at the bottom, I believe those are credit spreads, right? It's FX and then high yield credit. Notice that you had all this rate volatility. It didn't do much to credit vol. But as you'd mentioned just a minute ago, it just picked up at the beginning of this year because it wasn't just vol in rates, it was the move in rates too, right? So it was one-way vol, as you call it, right? And so, this, I don't think that blue line settles down back into the range until we get clarity on the balance sheet. So that's why I keep telling everyone, when we had our macro call today, I'm like, I think you got 6 more weeks of this vol. Because until we know what the Fed is doing, the bond market's going to be super nervous.
So we'll see how much wider everything is. Here's mortgage spreads wider. I mean, the mortgage market, a lot of debate on it. I talked to a bunch of different people that run trading desks this week, and some are massively worried about Fed balance sheet, think mortgage spreads go wider. Some think it's fully priced in. So, I mean, I guess that makes the market.
I mean, that's the thing. It's these two extreme views, right? And I think that says about a lot of it. But, I don't know. The Fed has this propensity. They want to get out of mortgages. And, the layman thinks that by the Fed buying agency mortgages, they've driven the house price appreciation through the roof. Pun intended, I guess. But, as you think about it, as we've always said, the only reason they bought agency mortgages, they'd own too many treasuries, right? Yeah. It's just an interest rate sensitive product. But they seem to want to have this bias. So even though the purchase program was 60% treasuries, 40% mortgages, the unwind's probably 50-50 as they try to do it. But the problem with mortgages, they're this long maturity asset, but you have this principal that comes through, you have prepayments. I don't want to get too funky on all this. So it's highly dependent on the prepayment environment on how the Fed gets out of the mortgage market too, unless they sell. So there's been a lot of analysts and strategists that say the Fed should sell the mortgages.
Yeah.
So I get that jitterness, and our agency team has been pretty jittery about it as well, and I obviously respect what they do.
But I think the market expects them to sell mortgages right now. It's just, some think maybe, like you said, more than others. So that's TBD on how that plays out. IG spreads, this is looking at CMBS, AAAs, and AA, more investment grade. Very, very wide. This is 5-year average on AAs is about 66, and that's the red line. We got way above that. We've had a rally the last couple of days.
Yeah. But I think that was just a yield buyer, right? I was talking to the head of one of the fixed income ETF desks, and just trying to get a sense on market color, and she was telling me that ultimately 6.5 was what everybody had in the sign.
Yeah, LQD was 4.
Yeah,
right?
It was 4 on LQD, 6.5 on HYG, and those were the numbers. And she said they saw it in droves, come in 25 basis points one day, right? Yeah. So that's 1.25 roughly on a 5-year asset, right? So you've seen that move. Now the question is, if you widen back out, do you have that thing? Because we always talk about velocity, right? So you have the target, but then when you test it the second time, usually the move is a little bit less as well. So. But 6.5. Remember, high yield was yielding like 3.5.
Yeah.
Right.
Like 12 months ago, it was 3.5. Yeah, the summer of 2021.
It's crazy, right? So I can see why. I mean, people were prepared to nibble, and they're starting to nibble.
Yeah, and the high yield market is the index. If you go and look at historical spreads, and one of the things I've been talking about is this 450 number on high yield OAS. Here you have high yield and bank loans on here, and 450, if you look at 2019, is kind of the upper range that we bounced off across after we rallied from 2018. Yeah. And I thought we'd get up to that 450 number. We got to like 411, 412.
We didn't need 450 because you had the treasury move in there too. See, that's what it's that yield, the all-in yield, right? So I was giving you kudos when you told me this. You're like, oh, I thought we'd get there. I'm like, but we got there in the yield basis because the 5-year moved so much.
That's right. I had dinner with or lunch with an investor maybe 2 weeks ago, and I think high yield was at like 575 or something back then. And you pointed out when it got to 6, and I told that investor, I'm like, look, if we get to 450 on spread, and let's say the 5-year gets to 2, and this back then the 5-year was like 175 probably, right?
Yeah.
I'm like, then at 6.5, that's almost like long-term equity returns without the vol, right?
Yeah.
And I think that, that you can look back at high yield and it's been at a wider spread and it's been at a higher yield. But looking at that wider spread, the high yield index I think was riskier like 4 or 5 years ago.
Yeah, because I think what you've seen, the improvement in energy, right? There's been a consolidation or some bankruptcies along the way too. Obviously, energy now, they haven't had all the CapEx and just high debt payments. They've refinanced it down. So the quality of high yield is better than it was.
It's still risky.
It's still risky.
It's better.
But like you substitute stock for that. I love how you said that too. Like, what's kind of long-term return on stocks? And probably there's a lot of people watching this, or whoever watches it, that says, wait a second, don't stocks do like 15, 20% a year? No, the long-term risk premium is like 6.5%, 7%.
Yeah.
So, we just gotten spoiled for so long that we've had all these policies out there. So, I think that when you're buying high yield, you're not selling treasuries to buy a high yield unless you're an allocator like we are, right? Yeah. You're doing it out of your risk budget. So I can see people saying, look, this equity market, it's a little rough. Maybe I just want to dial this back, and like 6.5, it's probably going to be a real yield that's positive, and I can take some defaults, right, and still make money.
And the market, as you look at high yield, and this is the difference between triple Cs, which are the riskiest, and double Bs, which are the safest, the spread is pretty low on a historical basis. When it's wide, it means that the triple Cs are trading way wider, which means the market typically believes that there's a higher default risk out there.
Right, and this is a bullish story for credit right now still, because even though we've seen spread widening, and you've seen that across really all credit products, it's not the lowest quality that's driving it. Yes, they're out a little bit more just because they are riskier. They should get a little steepness in the credit curve, but ultimately, this doesn't have a harbinger of the negativity that I think a lot of people would make out of the spread. So when you start to dig underneath the hood, you find that the market does look a little bit better than what you'd see with the headline numbers.
Yeah, I mean, usually it's the triple Cs that are widening first, right? This time it was really a big duration hit on the double Bs. They typically have a little bit more duration, a little higher dollar price. And here's the market. This is the high yield and levered loan. Market's assumptions of default rates. Yeah, it's coming up a little bit off the extreme lows of 2021. But it's still much lower than it has been historically in the past.
Right, and like people usually model high yield, they say on average it's 2. The average is never the average experience, right? It's under for a while, then you get these big moves up. But the market is not thinking that we're going to some big default area. I think if you see continued slowdown in consumption, continued slowdown in GDP, the market will start to price a higher default rate. But right now, just given where, as you said, it's a better quality asset, where coupons were when they were originated, it's a lot cheaper for these companies to be able to finance the market. That's the benefit to corporations in a lower yield environment.
Yeah, and I will say our credit team was very positive on credit, and now they've got kind of, they're not on recession watch, but the outlook is definitely not as good as it was because input costs are on the rise.
Yeah,
right. So there's some companies that can pass that through onto the consumer. There's some that are going to get margin squeezed. So, they try to find names. And they started this, about 12 months ago. They started, and we just had Robert Cohen on last episode of Channel 11. He talked about how they were been trying to find names that they like in the riskier parts of the credit market that have the ability to pass on some of those inflationary pressures better than others.
Yeah.
Right.
Yeah. And like Robert told us this week too, he's like, look, this loan market's held up really well. High yield hasn't as much. Maybe we should be taking some loan chips off the table. Everybody's focused on the floating rate component, but ultimately, when you look at the yield differences between the two, and he thinks they're somewhat fungible, right? Yeah, you got to buy a little more duration in it, but given the rate move we've seen, kind of makes sense to rotate a little bit into high yield from those loan positions. So I know that's something they've been doing at the margin.
Yep. And EM, which has been hit the hardest, obviously a lot of it has to do with Russia. If you strip Russia out, it's we actually did that here, the blue line. You can't really see it. The blue and red. Red is with Russia, and blue strips out Russia. But you're basically at hitting spread levels that you haven't seen outside of 2020 since the kind of the energy crisis in 2015. Usually when you get up towards that 400 area, you can see a bounce in late 14, you see a bounce in late 2018, early 2019 off that kind of like 420 level.
Yep.
And we're kind of right around that 420 if you strip out Russia, or wider if you add Russia. And if you go to this is kind of a larger basket, if you go to the high yield EM market, it's even worse. I mean, there's stuff that's down 12, 15%. So there's definitely opportunity there, not for the faint of heart.
Yeah, but I think that's the thing, talking to Luz Padilla, she was commenting in our investment meeting yesterday about, the whole concept of like, okay, she usually her radar goes on at 400. She's like 400, 350 is where you want to start looking, 375 is a buy, 400 you want to really get more aggressive. And we cut EM back in January in their asset allocation because she's like, I don't know, the risks are there. We were talking about how it's going to be more challenging with rates. And then the balance sheet, I'm concerned about the shortage of dollars. That's what causes problems back in 2018, was that you had this market that couldn't access dollars as well. So when talking with Luz, she was really saying that there's just the risk have been elevated too. Forget the crisis that's going on right now, but you're seeing more risk in the system because now you got dollar funding issues. So we'll have to see. And with the Fed going to remove more liquidity, it's usually not the time to want to step into EM. So I agree with you. It's not for the faint of heart. If you're going to do it, I think you want those double digit. You want to go into the high yield.
I mean, there's a reason they're double digits.
There is, and the market is. It's not that we're smarter than the market. The market knows exactly what we know as well.
Yeah.
And so I think that it's going to be a challenging environment. I think to really want to step back into EM, we need some more, kind of calmness in markets. And I don't think you get that until we get the balance sheet.
Yeah, we've talked about, is it time to add? And it's been kind of like, don't sell what you own.
Right.
But don't necessarily add more of that risk.
I know one of the younger product specialists that covers EM. He's like, what do you mean we're cutting? Because he loves, he's like a portfolio manager. He loves his asset class that he covers now. He's like, why would you guys cut 375s? And I'm like, didn't you listen to the thesis?
Yeah.
And he was like, yeah, but we always talk about this. I'm like, you always talk about it, but that's in normal conditions.
Yeah.
We're not in normal conditions.
And of course, the dollar's been strong, and the strong dollar is a headwind to emerging assets as well.
I got really no view on the dollar. I don't want to short it at this stage. Maybe we go back to 96, but we're not playing for pennies in this market. That's another pun intended on the dollar, right? Full of them, I guess, today. But I'd rather just wait to see this break down below 94 or something back in those levels. I want to see what policy. Can the ECB get hawkish like the Fed's done? They're starting to sound like it. But that could be really the catalyst for a move in the Dixie. So again, this is another one I want to play on the sidelines. That's why I say just sit here at home.
Well, you're long.
Yeah,
you're
right.
long.
I'm long. Yeah, I've got some in my pocket. So it's no problem.
What's funny, you talk about pennies. Like I was, with my kids at this one place where you put the pennies in, and it flattens them, and it gives you a little
Isn't that illegal? You're destroying currency.
Yeah, my kids are like, can we do this? I'm like, I don't have any pennies. I had to go.
Yeah, because you need the 2 quarters.
Yeah, I
think
I had to pay up to get pennies. I had to pay extra to get pennies.
Copper's expensive. Have you not seen copper prices?
Wasn't nickel's worth more than a dime now, right?
Yeah, I used that joke and no one laughed at it, but now you're recycling it. That's the old Yogi Berra quote.
Equities, everyone's favorite place, the land of gains. You can sell, as bond investors, we're very bitter because when equities are up, you can sell it because it can go up more. There's always earnings growth and multiple expansion. And when equities are down, you can sell it because it's cheap.
Yep.
Bonds, it's very asymmetric. So until yields go higher, we're in a tougher slog. But we were all about value over growth. It had underperformed forever and ever and ever. And finally, it looks like here you have year to date in the green, value only down 1.5. A lot of it, of course, energy. If you stripped out energy, it wouldn't be as compelling.
Yeah, but look, the value sectors are the leaders, right? Industrials, healthcare, staples. I mean, but it's also been a defensive market, right?
Yep.
So, I'm not going to claim victory on the value. Yes, it's worked. I'm not going to claim victory because the thesis isn't really there. It's a little bit of a crisis thesis right now. But I just still think the multiples look way, way more sexy. And they're less interest rate sensitive.
And energy probably has some of the better growth prospects out there too. So, yeah, it's value, but it's got a little bit of potential growth now too.
Yeah, no, absolutely.
So even though it's up a lot, it could continue to do well. S&P death cross.
Yeah.
And
bounced right off the death cross too, right? We got the death cross, and then we've had a little relief rally here too. I kind of feel like there's a little bit of relief rally coming in the quarter, but there's going to be some rebalancing and things too. Because even though bonds are down, stocks are down more. So you could see that there was the index. It was like quadruple witching day, or it is
triple
today.
witching, yeah.
It's quadruple actually. There's 4 today.
Okay, so Bloomberg was inaccurate this morning.
Well, that's what I read was 4. So maybe
Okay.
maybe my DMM source is not good here, which I would think they would know. But that said, it's one of those days. There's a big index rebalance too. So I could see us pushing up a little bit and then trading sideways for a little bit. That chart is just amazing off the lows in 2020, though. I mean, that is the land of gains, as you call it.
Yeah. I mean, it's been quite the ride. The only thing that got me on the bounce was it just didn't seem like the market was as negative as I thought it would when we see a low in equities. Like the put-call ratio on the S&P wasn't, there wasn't as much protection buying. A lot of people had maybe unwound already.
Yeah, and I don't think anybody's really short. I don't think this is it was a short covering rally, because if you look at like the momentum funds and the CTAs, it didn't seem like they were very short. So I think it's, I won't call it a bear market rally because we didn't get to where we were bear market territory, but it sure feels like, that's why I called it like a relief rally, right? It was just so negative for so long that all of a sudden you're going to get a bounce. But and I think the stock market also found faith in the Fed. They're like, okay, they're taking some optionality. Yes, they're going to be aggressive. And you look at the bond market, it's already priced that way. So you know what? The fear from the Fed probably got removed for equity investors. They got another 6 weeks now. Let's wait for the balance sheet. So I that's why I think you can see this kind of risk rally in the near term for that reason.
Yep. Cyclical defensive basket. Usually when you get up to this, the 2 standard deviations, you see a correction, and we saw a correction, or we're still seeing a correction, I suppose.
Yeah, and to get back to that kind of average, right, or that kind of rolling average, it takes like a fourth quarter of 18. So in order for this to get back to kind of that average valuation or average performance, it would take another 10-15% down the market. So I don't read too much.
As scary as that sounds, people forget we're up 30. So if we go down 20, you're still in the long run. It's been a good ride.
Yeah,
so
no, absolutely.
It's just losing money never feels good.
Nope.
Right. Here's growth over value. Obviously, in the near term, value has been performing well, but growth had a decade-plus long run.
Well, when you have inflation and you have higher rates, growth is not as scarce, right? You're not just trying to find this area. And that's what I've been saying about the whole value trade, is that you need some scarcity of growth to keep the growth multiple high. And now we have a lot more robust kind of areas to look at. And so I think that's what's really driving this.
And it's not just been in the U.S. This is global, ex-U.S. Same theme going on.
It's global
big
rates,
rally,
it's global inflation. I think it comes at the same thing. Sorry, I cut you off.
Oh, I was going to say it started in 2020, took a step back, but outside of the U.S., you also have a lot more less tech there, right? In non-U.S.
Yeah, and that's kind of the thing about the U.S. market, right? Is that we are so tech heavy in our indices, right? And we're tech heavy in our utilization of everything too. So I think if you pulled like Korea, you would see a similar kind of concentration. But in general, the world, it doesn't drive tech. The U.S. drives it.
Yeah, and what's gotten killed the most, or one of the things that has gotten killed a lot, is of course this unprofitable tech, the stuff that benefited the most from the TINA, the zero rates, the negative real yields, and we've seen a huge correction. So for those that have a very long-term horizon, there are definitely some assets out there that are down 50, 60%.
Oh, yeah. Well, I mean, there's some big ETF out there where that person owns a lot of these names out there too. And so, the old trading adage is like valuation is never cause for a correction, but once you have it, it's the high valuation that's going to get hit the first. And so, they're non-profitable. So, this is not one I would want to step in front of. Maybe you can be a good stock picker here on these levels and say, okay, this business is going to turn around. They're getting to that level. But this is not one of those you want to play mean reversion on, I don't think.
Yep. Well, here we have some slides just to show you that there has been a pretty decent repricing. This is trailing PEs, however, but pretty big repricing in many parts of the equity market in the U.S. Here's the S&P 500. Here's the mid caps. S&P 400. Here's the small caps, even bigger repricing. So there
And
has been.
It's interesting. Those two charts, they're both at like a 17.5 multiple, right? Where the large cap is still with the 22. I mean, it's obviously dominated by a few names there.
Yeah.
But it's kind of interesting to see that that's kind of the multiple. And then you look at like Europe, you look at the developed world, and you see the multiple's about 17.5. So there's this. We are kind of gravitating there. The thing that is the outlier is the S&P 500. And it's because of that darling story about the tech.
So there's definitely been a repricing. There's definitely some bargains to be had for stock pickers out there. And unfortunately these days, just out of not sitting in my home office with no noise, I turn CNBC on just to like have a voice in the background.
Yeah, well, there's your stock pickers for you, right?
And then so you hear about. There's a lot of excitement around some of these beaten down names. It's amazing how long they could talk about single name stocks on CNBC for. But
well, look, we talk about bonds all day long, and most people would say that's boring as hell too. So I mean, so to each their own, right?
U.S. equity prices, rest of the world. Again, look at these long-term charts. It's been such a big run that at some point, it's taken a longer-term horizon, and not just in the near term, adding outside of the U.S., especially on some of this weakness that we're seeing now, maybe something interesting to look at. Here's the S&P 500 versus MSCI Europe, and
I mean, you show there it was working, right? It was working in the fourth quarter when we talked about it. It was working. It worked quite well there, and then that was just essentially the invasion that really drove that back up, right?
That's right. Yeah. And here's S&P versus EM, same thing. It had been working, and then after the invasion, U.S. the safest place to be, obviously. So those are our stock charts. We've kind of been pounding the table for the same thing. Don't have any reason to change it outside of a little bit more cautious on Europe and emerging markets. And now we're going to go to the real land of gains, because equities are not the land of gains this year. Commodities, just look at that run up from the lows in 2020.
Yeah, I mean, look, you can see the previous low, we finally broke through that. It's kind of where we turned bullish on commodities as well, from even a fundamental standpoint. And when I see that chart, this is a log chart, by the way, so that's a huge run up at the end. And that's where when clients were talking to us, I'm like, look, sell some. There's nothing wrong with selling a little bit, so 30-40% up for the year.
Yeah.
Take a little bit off the table and go buy some stocks. Go buy some bonds. Go rebalance a little bit, because you don't get commodities don't run 200-300% a year, right? You don't get to. You can get a stock market that can run. Remember the fourth quarter of '99? It was like 110% on like mid cap in the fourth quarter alone. So you can get these runs in certain markets, but we know that there's pain in this market for everybody else. So the reason you own commodities is because they can offset some of the pain in other parts of the portfolio.
Yeah, so commodities are always very, I think, challenging for a lot of individual investors, because there's years where they do nothing, or they only go down, so they diversify in like the bad way, right?
Yeah, right.
So what advice do you have to people? Is it something you have to time?
I think it's hard for someone in retail or an advisory component to really time commodities. And so it's something that we'd studied for a couple of decades. I started working in commodities back in 2005.
How do you feel about commodity-related equities as another way to get the play?
It's another way, but you get stock beta. So
which is why it's underperforming now.
Yeah, it's underperforming now. But the energy complex, it's been correlated to oil out there. So I've never liked gold miners or silver miners. I just think they're poorly ran companies. They hedge at the wrong time and stuff. Some of the agricultural side can do well too, like the John Deeres and the equipment manufacturers as well. But at the end of it, it's not the pure play, right? And so I don't think you should have 20% of your portfolio in commodities. Well, some people's portfolios did become that, but I think you should always have at least a few percent in commodities. And so I just say 5. You don't do anything in the portfolio less than 5, right? It's not worth it. So I think that's the way that people should think about it. But the stock market too, you're just going to get equity beta as well. But look, if the equity market's tanking, usually commodity markets aren't going up, right? Yeah. If it's a commodity cause slowdown, that's different.
Which could happen.
Which can and that's my fear, especially how quick it ran. I mean, the gasoline prices went up it went up like $1.40 in like a week here, and it's like, whoa, that's truly sticker shock.
Yeah.
And the pump still only lets you get $100 on your credit card run. So you can't even get a full tank of gas.
Yeah, it was the first time I was driving home, and I'm kind of like lazy to go to the gas station. I'm like, maybe I should just fill up today. It could be more expensive tomorrow.
Well, I was stoked because I was like, I only paid $5.50 a gallon for this stuff, and then all of a sudden now I'm like, what do I do now? Now I got to. I'm close to fumes, so as I leave here today, I'm gonna have to go get the gas.
And lastly, I think this is the last slide of the day. This is just across the commodity complex here. It shows 1 month year to date, 1 year, just to show you the kind of crazy 1 month moves. Any comments just as you look across kind of the universe of commodities?
My first comment is look at nickel. Wow. By the way, 3 days ago, that number is 250% on the 1 year number. There was a big short squeeze out there. You can read all about it. It's very complicated, but effectively, the London Metals Exchange shut down nickel trading, and they reopened it.
Very controversial, right?
It's super controversial.
Some people were making a lot of money, some people were losing.
We were trying to unwind some of our long nickel positions because it became too much of our portfolio because of the huge move. And those we couldn't get the trades done because they weren't trading. The trades that got done were all canceled last Tuesday. So then they were like, we're going to reopen on Thursday. No, it's going to be Friday, Monday. And when you start to look at it, it's like you realize that, okay, first of all, the LME is owned by a Hong Kong entity. Where's this big guy that's getting short squeeze? He's out of the China region. And by the way, he got his financing lined up because he was getting margin called. And so the market was squeezing him, but the LME essentially bailed him out.
Yeah.
Right? Now it's limited down each day. They can't figure out what the limit should be. It was supposed to come out 10% was the ban the first day. There was no limits before, which is why we had this problem. In the U.S., there's limits, by the way, on how much a commodity can move in a day. Except for like oil, it has to take a pause, like a circuit breaker, like in stocks. But what happened is that they were like, okay, it's going to be 10% when it reopens. Nope, now it's 5%. And it's like, but if you look at the proxy markets, they were down like 40%. So it's like we're going to have 8 or 9 trading days. Well, it's actually 9 because compounding works the other way when you're losing. You have to have 9 trading days to clear that. So then they went to 8%. Today it was 12, and it opens limit down every single day so far, and it opens limit down and trades like 3 contracts. So no one could just. So I was talking to some dealers out there too that do index product, and they're like, look, we're just taking basis risk.
Yeah.
We have to keep going. And he's like, and we just charge more for it.
Yeah.
So to me, I've made a plea on my podcast this week. If the CME is listening, if you're listening to Channel 11, which you should be, it's good information. List nickel contracts here in America. You already have copper. Why not go after them? Take their business away from them. They don't deserve to do that because they're the clearing party, the central clearinghouse. They should make the markets work. You don't bail out traders. You make the markets function. So, and if you want to read some entertaining, very vitriol stuff, go to Cliff Asness, look at his Twitter feed. He is livid about this because he's long nickel, obviously, in something. And he is just incensed by this, as we all are.
Yeah.
And it just shows you that they shouldn't be in business, is my point. So CME, get a nickel contract listed, then go after the other ones. Go to aluminum, get the rest of them done too.
All right. So to close it out, we'll just recap our view for the rest of the year here. It's going to be a choppy market with the global geopolitics stuff going on, the war, you got the Fed. So, be patient out there. We still got to kind of watch and see what happens with the Fed. We're kind of on recession watch here with growth data. Still looks okay. You just have a lot of sentiment that's gotten worse. Fixed income.
But remember, we're fixed income investors primarily. Recession watch is in our DNA.
That's
so
right.
Just being on a watch doesn't mean it's coming. We're
just back to normal.
Yeah, we're just back to not just all bulled up on everything.
Time to nibble or prepare to nibble on fixed income. We still like that value play in equities. A little bit tougher to be in EM and Europe. And commodities have had a big run up. Maybe take some chips off the table, but in the long run, it could still be a good place to be.
Absolutely.
All right.
So
well,
thanks, Ken.
Good to see you.
Absolutely.
All
It's
right.
always a
Thanks,
pleasure.
everyone. Good luck out there.
Okay.